Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Firstsource Solutions Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Maheshwari from Firstsource Solutions Limited. Thank you, and over to you, sir.
Thank you, Stephen. Welcome, everyone, and thank you for joining us for the quarter and the year ended March 31st, 2022 earnings call for Firstsource. On this call, Vipul Khanna, our MD and CEO, and Dinesh Jain, our CFO, will provide an overview of company performance, followed by Q&A. Do note that the results, fact sheet, and the presentation have been emailed to you, and you can also view this on our website, www.firstsource.com. Before we begin the call, please note that some of the matters that we will discuss on this call, including our business outlook, are forward-looking and as such are subject to known and unknown risks. These uncertainties and the risks are included but not limited to what we have mentioned in our prospectus filed with SEBI and subsequent annual reports that are available on our website. With that said, I now turn the call over to Vipul Khanna to begin the proceedings.
All right, thanks, Ankur. Good evening, everyone, and thank you for joining us today at this late hour. It's a bright, crisp morning here in California, but I should qualify that I'm generally slow in this morning, this early in the day, especially for this high-quality audience. So let me get started with a quick snapshot of the quarter gone by. Revenues grew 3.1% year-on-year in constant currency and came in at INR 15,439 million or $205.5 million. Operating margins were 11.3%, and EPS grew by 1.6% year-on-year. For the year gone by, we achieved revenues of 795.2 million, implying a constant currency growth of 14.6% in line with the recent guidance. Operating margins came in at 12%, and the EPS at rupees 7.6 grew by 19.4%, normalizing for the exceptional charge last year. The higher increase in EPS is particularly heartening for us, considering the inflationary pressures, especially in the back half of the year. Looking back on FY22, this has been a mixed year. On the one hand, we are disappointed at underperforming to the guidance we set up at the beginning of the year. As we have discussed on past calls, a medley of macro headwinds impacted many of our businesses. On the other hand, we are pleased with our focus, our investments, and our progress in strengthening the foundations of each of our businesses. We believe this sets us up nicely for FY23 and beyond, notwithstanding the impact from the expected significant decline in the mortgage origination market in the coming years. The strategic focus that we established a couple of years back has 3 components. 1, invest in our 3 core industries of banking and financial services, healthcare, and comms, media, and tech. Consolidating our leadership position in our chosen subverticals and systematically adding growth adjacencies to them. Similar to BFS and healthcare provider business, our HPHS business has now achieved leadership position in its targeted segment. The acquisitions of TSG and ARSI have added valuable growth pools to mortgage and collections respectively. 2, push forward on our digital solutions and services to take disruptive offerings to markets in each of the industries. Our offerings like digital collections for consumer debt and digital intake in healthcare are now recognized category leaders and growth drivers. And 3, above all, build a purpose-led, scalable, and agile organization. This mission is steadily taking root and helping attract world-class talent and is more importantly, resonating with clients as they progress on their own ESG agenda. Let me talk in detail about our segment performance and the road ahead. In financial 22, our banking and financial services segment grew 11.1% year-on-year and 9.7% in constant currency. BFS started out strong, but collections and mortgage faced macro headwinds, some anticipated and some unexpected. UK BFS held strong and grew steadily. Let's talk mortgages. So while fiscal 23 will be a year of sharp degrowth compared to financial 22, we expect this business to stabilize by end of Q2 FY23. Mortgage rates have spiked dramatically since we last spoke on the back of the worsening macro environment. 30-year mortgage rates today are close to 5 to 5.5%, the highest we've seen in the last 12 years. For perspective, these used to be around 3% in December 2021. This big movement in interest rates has significantly impacted the refinance market. Additionally, we expect it will also start impacting the marginal buyers in the home purchase market. In reaction, our clients have been reducing origination capacity both in-house and with us and other partners. And while we are actively aligning our cost structures to the revised demand, the sharp pace of decline and lagged impact on costs will lead to margin pressures in financial 23. Nevertheless, the mortgage industry cost base is still very high for the reduced market volume. This will generate longer-term client need for strategic cost solutions encompassing deeper offshoring, automation on field and back office processes, and digital point solutions. We are evolving our solutions to align with our clients' current focus as we continue to invest for longer-term growth. So, for instance, we have prioritized specific accounts and have deeply engaged with them in crafting operating models for this new market cycle. I'm encouraged by the quality of client conversations and specifically the appetite for strategic changes to their ops model, in contrast to the breadth capacity augmentation approach of the last 2 years. We are seeing good traction for our post-close and the due diligence offering from the TSG acquisition. The services segment remains steady, and although there may be some near-term pressure on revenues as clients relocate excess refi capacity to servicing, we also see additional opportunities from likely uptick in 2 areas, default servicing and securitization volume. Sales efforts continue to yield good results. We added 4 new clients this quarter. Recognizing our strength, portfolio size, market impact, and competitive positioning, we are pleased that the Everest Group has recognized us as a leader in the mortgage operations peak metrics 2022. Amongst the volatility in the originations market, it is easy to lose the perspective that we have grown this business to almost 3x the size of what it was 2 years ago at the start of this origination cycle. We have provided historical data on market volume and portfolio mix in this quarter's IR deck. Normalizing for the refinance revenues for the last 3 years, we've built a solid core of servicing business and a sustainable origination portfolio size. For our collections business, we are encouraged by the momentum we are seeing. Macro indicators are pointing towards a return to normalcy. As per the recent data published by New York Fed, outstanding credit card debt in January 22 surpassed for the first time the high set in 2019. Payment rates have begun to decline and the delinquency behavior is starting to come back. Delinquencies increased to 1.62% in the quarter ending December 21 versus 1.54% in the prior quarter. Please note, this is the latest Fed report and we await the March quarter data. As I mentioned earlier, we have been focused on a number of actions to strengthen this business by augmenting our sales leadership and capacity, enhancing the full scope build of our digital collections platform, which is now reaching critical mass, and diversifying into newer segments of fintech and utilities. To offset lower business volumes, we aggressively secured new client wins in financial 22. We added 11 new clients this year, most of these fintechs, white labeling our digital collections. These wins will deliver their full year potential in FY23, and sales momentum is expected to remain strong in the year. As consumer spending and delinquencies continues to rise, we should start to see volume recovery in H2 in the core card receivables management segment. We closed the acquisition of ARSI last quarter. The integration is progressing as planned. We are fine-tuning the operating model, adding more digital capabilities to their core platform. We've renewed the sales focus and the pipeline is building nicely. Cross-sell opportunities are on in full earnest. In fact, in the last 3 months, we have already secured 1 cross-sell win. As previously mentioned, ARSI operates at a lower margin compared to the rest of our business. We are working through the cost synergies and operating model in SGA and expect it to come closer to the overall margin by end of the year. The UK BFS segment remains steady. In the past few calls, we talked about the talent supply challenges and their impact on revenue growth. We have strengthened our delivery architecture by opening a new satellite location in the UK to increase talent access and also targeted compensation adjustments. Over financial 22, this segment delivered modest year-on-year growth, and in financial 23, we expect healthy growth from this segment. The twin impact of a post-pandemic economy and continued digital adoption is driving a change in demand to more complex, higher-value services such as fraud management support, compliance transaction monitoring, and complaints handling. We continue to add capabilities towards creating a comprehensive customer lifecycle management suite. And while the talent situation in UK is structurally challenging, it also creates opportunities. Clients are now actively relooking at their location strategy for CXOps. The UK financial services segment is slowly but surely increasing its usage of chat as a CX channel. This bodes well for offshore growth. We had 2 meaningful wins for offshore chat this year. And lastly, strengthening our go-to-market efforts to drive new client wins is one of my primary focus areas for financial 23. Shifting to healthcare, in financial 22, healthcare grew 28.4% year-on-year and 27.7% in constant currency. Our HPHS business maintains its strong growth trajectory. It has been consistently growing over the last 8 quarters. Our fourth quarter 22 revenues are more than 2x of the revenues we delivered in fourth quarter of 2020. All organic growth. This business remains focused on landing and expanding into the top 10 health plans, digital intake, bespoke BPaaS solutions for mid-market health plans, and co-creating telehealth RPM solution with our clients. I'm pleased that we are now participating in winning large complex deals, leveraging our solution skills and platforms. The growth trajectory of this business has validated the playbook of driving top quartile growth in a mature market by investing in leadership and go-to-market capabilities and by taking disruptive solutions to clients. We are pleased that our efforts have also been recognized by experts. The Everest Group, citing our digital-first approach, disruptive solutions, and strong execution, recognized us as the leader in the healthcare payer operations peak matrix for 2022. And we expect this growth momentum to continue in financial 23 as well. The growth in our provider business has been impacted over the last 2 years. COVID impacted consumer behavior, hospital priorities, and disrupted the revenue cycle for healthcare providers. And while the public health emergency has been further extended, we are seeing that hospitals are now far more open to engage. The talent supply and cost challenges for this industry are acute, and we sense an eagerness amongst clients to explore more strategic solutions. Earlier in the year, we renewed our focus and investment in sales, solutioning, and products. These are now beginning to pay off. During fourth quarter, we achieved more new wins than any other quarter over the last 3 years. Our strategy for this segment is to develop any digital solutions for the RCM value chain, grow into geos in the US where we are underpenetrated, and develop stronger capabilities in receivables management. We are pleased that we've been ranked number 1 in the 2022 Best in Class Software and Services report and noted as a leader in the Eligibility and Enrollment Services category. This report is based on the insights gathered from thousands of healthcare organizations, including direct feedback from our customers. We are now more confident of the provider business coming back to a growth trajectory this year. With the continued strong growth of HPHS and the return to growth of provider this year, healthcare should be the flag bearer for companies' growth in the coming year as well. Finally, our communications, media, and tech segment continues to perform well. In financial 22, the segment grew by 17.5% year-on-year and 12.5% in constant currency. Our largest client's business remains robust, as does the health of our relationship. As I mentioned earlier, the UK talent supply challenges have necessitated the fine-tuning of our client's location mix. We successfully transitioned a few complex operations from UK to offshore. This impacts revenue, but is more profitable. Notwithstanding, in financial 22, we delivered mid-single-digit growth, and we are confident of similar growth in the coming year, given the rampant progress and potential new opportunities. The rest of our CMT portfolio made healthy progress in financial 22, growing by about 50%. In this quarter, we added 3 new accounts in in tech across CX, automation, and brand safety. Finally, the last comment. The digital media market continues undergoing a massive change with the shift from print to digital, and within digital, the shift from ad revenue reliance to more subscription-based models. Subscription revenues necessitate higher levels of customer engagement and innovative strategies for acquisition and retention. We are operationalizing tools to deliver personalized user journeys, resulting in greater acquisition and retention of subscribers. We are excited about this playing meaningfully in this segment. Considering the growth momentum across businesses and the macro environment, we are guiding to a growth of 7 to 10% for financial 23. This factors in the reduction in the mortgage business and growth in the others. Just to put this into perspective, our organic growth, excluding mortgage and excluding acquisitions of Stolen and ARSI, is expected to be between 18 to 22%. This is driven by go-live of recent wins across healthcare, BFS, and CMT, pipeline build-up and conversion, and gradual improvement in the business environment in the provider and collections market. As we mentioned before, this success in building a more holistic and diversified book of business is a direct result of long-term investment we've been making in the last couple of years. For the year, operating margins are expected to be in the range of 10.5 to 11%. Margins will primarily be impacted by three key factors. The sharp decline of the mortgage business in the first half of FY23 as we work to align the cost structures with revenue. We do expect to see a recovery in margins in the second half of financial 23 as this business stabilizes. Second, inflation, which is raging in the US and UK and is at a multi-decade high. While clients are receptive to price adjustments, there is again a gap in quantum and timing. And third, the modest dilutive impact of our financial 22 acquisitions of ARSI. FY23 will be a year of transition of our revenue composition. The business profile is less volatile and provides a strong base for sustained high-quality growth. We are confident on emerging stronger and delivering sequential growth from Q2 onward and on normalizing margins by end of this year. I will now pass over to Dinesh to cover the financial details.
Thank you, Vipul. Here is a quick summary of Q4 FY22 financial performance. Fiscal FY22, our revenue was $59,202 million or $795.2 million. This translates to constant currency growth of 14.6%. We achieved operating margin of 12% and PAT margin of 9.1%. Revenue for Q4 came in at $15,439 million or $205.5 million. This implies a year-on-year growth of 5.5% in rupee term and 3.1% in constant currency term. On the margin front, operating margin came in at $1,751 million or 11.3% of the revenue for the quarter, which is 3.2% degrowth on year-on-year basis and implies margin decline of 102 bps. Profit after tax came in at $1,324 million or 8.6% of the revenue for Q4 FY22. This is 1.2% year-on-year growth on normalizing with the margin decline of 37 bps. In Q4 FY22, we generated $1,119 million cash from operation. Our free cash flow was rupees 855 million. After adjusting for capex of $264 million, for full year FY22, our cash flow from operation was 7,870 million and free cash flow was 7,141 million. We declared and paid an interim dividend of rupees 3.5 per share with a total outlay of 2,439 million in the last quarter. Our closing cash balance as of March 31st was approximately 2,084 million. DSO came in at 57 days in Q4 versus 58 days last quarter. Net debt as of 31st March 2022 stand at 8,013 million or $105.7 million versus the 5,882 million or $79 million as of December 31st, 21. Tax rate of the Q4 was around 17%, but for year FY22, the tax rate was 17%. For FY23, we expect to be within the range of 18 to 20% for the year. On our forex hedging, we have coverage of pound 34.6 million for the next 12 months with average rate of around 114 rupees to a pound. Coverage for dollar is for $52.5 million with average rate of 79 rupees to a dollar. With also, I think the one corrections which we have in the fact sheet which have been sent out to you all guys, which is the onshore offshore mix for Q4 has a slight change in the numbers, which I think some mistakes there, which we have rectified and uploaded on the website, as well as I think has been shared to all of you guys through the mail. So please note the same. With this, we can open the call for the questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Manik Taneja from JM Financial. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, sir. Please.
Yes, Manik.
So thank you for the opportunity, Vipul, and appreciate the detailed breakup around the mortgage business across origination and servicing. I wanted to pick your brains on what we've been hearing from some of your peers who have been suggesting a very robust demand environment for BPM, saying that there are both larger deals, faster decision making in terms of client decisions than what we've been used to. Could you comment on what you think about this aspect, and is this being driven by the underlying tight labor market conditions? And the second one essentially is if you could also talk about what proportion of your business comes in from the digital native customer base and how that has been growing in recent times. Would appreciate if you could talk about your strategy in this regard, given the fact that you have been teaching about our focus on the BNPL and the fintech customer base through the recent quarters. Thank you.
Got it. So Manik, your first question was around the overall BPM demand environment outside of mortgage. Yeah?
Yes, that's correct. So I wanted to understand some of your peers have been talking about larger deals and faster than the usual decision making that we've seen on the BPM side, because BPO essentially has been associated with longer sales cycles. If you could talk about what you are seeing in the marketplace.
Yeah. No, I think in general we are seeing as this, especially for this calendar year, I think the government has certainly strengthened. If you think about healthcare, if you think about CMT, banking, obviously we play in segments which are mortgage and collection, somewhat unique. But for instance, UK BFS, we are seeing good demand. Is it large in structured deals? Yes, I think a little bit spotty, depends on the segment you play. But in general, I think the tactical opportunities that people had to do over the last 18 odd months, I think they're now done for. Now it's more about stepping back and seeing, the labor market, the cost situation, inflation. I think this is prompting a little bit of step back and think about more strategic deals. And if I could comment specifically on mortgage, while we've seen a sharp pullback in the current capacity, but that's kind of tactical action. What we're seeing is that the cost base is out of whack with the new reality. And even that segment is saying, step back and saying, how do I now align my cost base more structurally? And that invariably means more strategic outsourcing, including all components of it, right? And not just sort of capacity augmentation or tactical. So yeah, I would echo that, the comment that you kind of mentioned. On the bond digital segment, we have two focus areas. One is around fintechs, both for our collections offering as well as border. And the second one is the digital media segment for now. The fintech segment is growing very robustly. We want to take some collections and we are seeing other wins in back office and customer service. Obviously, this is dotted by smaller names, so the individual deal size are not massive. But BMTL segment, if I look at sort of the progress we made in the last 6 odd quarters, we built up a very nice portfolio of about 6 of the top 10 and some outside of the top 10 as well. And I think that segment as a share of payments is increasing. So good progress there. This is one of the focus areas for 23, that how do we go beyond collections into more meaningful areas of fintech, including going into the crypto arena, because that is kind of sucking up a lot of capital, a lot of investments into going, consumer investments are going there. The demand for servicing there has grown up. We've had 2 wins in the crypto segment, small, but the onus is on us to build on that foundation. And then digital media has performed really strongly. We had 3 wins this year. And given the, going back to your comment about strategic, given the quality of solutions they need, again, I see good demand for strategic solutions on the digital media segment. We are currently narrowed on this too, while we continue to work on the big tech companies, right? That is something which we continue to kind of chase the market and try to find meaningful opportunities in the big tech of the bond digital clients.
Sure. And would you want to call out the proportion of our revenues from the so-called digital native customer base currently?
You know what? So we need to kind of do some alignment. Right now, we run it in 2 segments, right? We run it in the BFS and we run in the CMT segment. So we need to kind of start to find a way of kind of give out that cut of the revenue. I don't have it handy, but the other proxy for that, if you think about the digital revenues per se, right? From a service line perspective, what we call as digitally powered contact center, back office, and platform and analytics. So the platform and analytics portion has a good jump, and for this quarter, that was about 19% of the revenue. Slightly different cut from what you're looking. This is more inherently digital solutions bought by companies across the quarter.
Sure. And one last one, basically, this structural uptick in terms of demand is driven by the labor situation in your view?
I think it's labor, and coming out of COVID, once you're done with the tactical action, you already had digital going. It's now about stitching it together and starting to look at a broader value chain, a bigger portion of the operations. Like for healthcare, we're currently working on 2 extremely large RFPs from top 10 health plans, which not only encompass their existing portfolio with sort of the market, but also encompassing now other scope which has not been outsourced or has been considered more onshore centric, right? So now the openness of nearshore and offshore adds up greater opportunities to target the service value chain, right? Because earlier there was very clear distinction, I don't want to do it offshore, but now it comes up that as well. So yes, partly triggered by the talent situation, but technology and location adds up the 2 dimensions for the scope of these.
Sure. Thank you and all the best for the future.
Thank you.
Thank you. The question is from the line of Dipesh Mehta from MK Global. Please go ahead.
Yeah, thanks for the opportunity. Just want to understand our guidance for 23. Now, organic growth guidance, ex-mortgage acquisition, 18 to 20 is a healthy number. How you expect the trajectory of that number? Whether we will see steady ramp up across the quarter, or you expect it to be more back-ended kind of thing? The reason for asking is some of the segment like collection business still not reached to normalcy level. Delinquency is increasing, but not yet to earlier level. Similarly, provider side, PHE got extended, so recovery may be a bit delayed. So if you can provide how we expect trajectory to be, whether from Q1 onwards we expect normal growth sequential happening, or it would be back-ended. Second question is about EBIT margin trajectory. We guided 10.5 to 11 for current year, but how we should look medium-term Firstsource margin trajectory? Whether this year is exception and we will return back to our normal margin trajectory entering into FY24. If you can provide some medium-term outlook for margin trajectory, considering the business mix change, what we expect to happen over next few quarters. and investment plan? Thanks.
Yeah. Thank you, Dipesh. And Dipesh, given your generally your questions and data, we've given you a lot of data this time on the mortgage side, so there is full perspective, right, on how it is moving. So trajectory over the year, at an overall company level, Q1 will be flattish because the impact of mortgage decline will kind of take away all the growth that will come from other sectors. And we expect mortgage sort of will bottom out by Q and then start to stabilize and sort of have modest growth. That's just on mortgage for the year, and its impact on the year. I think HPHS will be steady growth through the year. Provider is starting to pick up, but I think the volumes will pick up as we go to Q2 and then more growth in H2. UK BFS, I think, will be steady growth through the year. Collections, I think, has started out strong. I'm cautiously optimistic that we'll start to see growth a little bit better from Q2 onwards rather than all towards the back end. But overall, if I add up everything, the impact of mortgage and the growth in other sectors, Q1 will be flattish. It'll start to pick up in Q2, and then we'll see healthy growth in Q3 and Q4 from a revenue perspective. On EBIT, your instinct is absolutely right. This is a year of transition. We are replacing almost 10 points of our growth from mortgage with more steady, sticky revenues, right? So there's a 10% switch of our revenue switching from mortgage to the more profitable one. This will weigh heavy on the first half of the year as far as margins is concerned. But we expect that by end of the year, we'll start to come back to our current levels. So we expect to kind of get EBIT at about 11.5 to 12% by Q4. And then as we get to FY24, we should be back to our normal guidance of keeping it at that level and then starting to give net saves of about 20 to 25 basis points on that level. Does that answer your question, Dipesh?
Yeah, it does answer. Now just two questions. First about the top account, the top telecom account which we have. How we should look at that business growth? Because earlier you expected some supply side challenges. Now you are indicating to some extent we have find ways to mitigate it, but it have deflation because offshoring is one of the way to take a lead. So considering all these moving items, how you expect top client to perform for us?
Yeah. So as I said, this year, so the year gone by, FY22, we got sort of mid-single digit growth net after everything, supply side challenges, movements to offshore, but also tested out new things from offshore, which kind of opens up new vistas. I think that will be an important growth driver. And then going into next year, at this point, we are forecasting we have similar sort of growth trajectory going into next year, FY23. I think that the UK market is challenging. That is kind of forcing an element of rethink on the location strategy. We saw that in FY22. I think I'm again cautiously optimistic that we'll see more manifestations of that and open up more scope as far as different geographies is concerned. And also now with our digital becoming more real and chat especially becoming more acceptable as a mainstream option, not for just emerging companies, but for mainstream large banks, large telecom and internet providers. I think chat will become an important driver for growth, and chat is very global, very offshore. So net, that's kind of the color. But we are confident about decent growth, mid-single digit growth from the large clients. And lastly, if I could point out that a couple of years ago when we started, this account was about 20% of our revenue. But with other growth and yet delivering net growth on this account, this is now about less than 15% of the FSL revenue. So fairly good gains in terms of reducing the concentration risk from the large account.
Understand. And last question from my side. We have guided 7 to 10%. So if you can help us understand your assumption for low end and higher end, so upper end, lower end, what kind of assumption you have made and how one should look the trajectory playing out, which give us confidence we will be in next couple of quarters, we will be closer to upper end than lower end.
Yeah. So obviously this is what we see today. One big factor, as always, right, to have a range at the start of the year is the timing of pipeline closure, the timing of deal closure, sorry, and the timing of go live, right? That's one factor which plays out amongst different businesses. I think for now we have built in a reasonable amount of intelligence in how the market, especially for provider and collections, evolve. I think the other variable to think about is we obviously have two meaningful acquisitions which we are integrating and kind of taking those new offerings to our existing clients, as well as for Stonehill. They operate in the long tail of the mortgage market, right? We have traditionally focused on the large clients. They focus on the long tail. So it's about we understanding that market and taking some other offerings to that market. So that variable of cross-sell into each other's market is the other variable which has gone into the 7 to 10% assumption that we have. I think the timing of some of the recovery in collections and providers has a bearing in terms of whether we play on the upper end or the top end. And the mortgage decline acceleration has been reasonably intense leading up to February, March, and into sort of April, May now. We are kind of hoping that we start to see more structural demand emerge towards end of H2 with meaningful revenue. We're not counting a whole lot, but that will be the last factor which will play out there. That's how we see the 7 to 10%. Ankur, anything I'm missing on that?
No, Vipul, that I think largely covers in terms of how we are seeing the next step to play out.
Thank you.
Thank you, Dipesh.
Thank you. The next question is from the line of Mihir Manohar from Carnelian Asset Advisors. Please go ahead.
Yeah, hi. Thanks for giving me the opportunity. I wanted to understand that you guided for 7 to 10% kind of a growth for FY23. So, is this only the organic component or at the company level?
This is at the company level, but this is all organic as far as starting the year is concerned. This 7 to 10% also includes the 6% impact, full year impact from the acquisitions we did last year. But going forward, there is no acquisition baked into this growth assumption.
Okay, so basically this 7 to 10% includes ARSI and Stonehill.
Yes, yes, please.
Okay, got it. Then
that is a 6% impact.
6% impact. Okay, understood. Yeah, sure. And I wanted to understand, on the delinquency side, we are seeing delinquency going up. So how do you see the collections part of the business? How should we model that for this particular year across the quarters?
So FY22 was kind of very muted, right? We were net flattish. We added new clients, but there were significant volume declines from existing clients given the exceptional credit quality. And as I said, the delinquency has started to pick up. The core card portfolio, obviously there is a lagged impact. Spending is up. Now by the time the payments start to kind of fall behind and you start to see people going overdue 90, 180 days, it takes time to build that up. Then the portfolio rises to us for collection. That's just in the core card collections portfolio. But I'm very encouraged by the digital collections platform is really kind of establishing its leadership in the market, and we are taking it across segments. Fintech has been great embracing, and I think the deals in there is resulting into revenue normal trajectory. Given they are of small base, they're not as much affected by the market trajectory yet, right? So we're seeing good revenue booking and volumes in the fintech segment, and we started to kind of make some inroads in the utility segment. And then the legal collections has come as a good shot in the arm. I think it's been received well by our existing clients both ways. So compared to a flattish last year, we expect strong growth from collections this year across both our core collections as well as legal portfolio.
Got it. Yes, sure. My side. Thank you.
Thank you. The next question is from the line of Sanjay Awatramani from Envision Capital. Please go ahead.
Yeah, good evening and thank you for giving me this opportunity. So just wanted some clarification that you have given 7 to 10% of growth for FY23 revenue growth. Is this understanding correct?
Yes.
And EBIT margin of 11.5 to 12%.
No, 10.5 to 11%, please.
Okay, 10.5 to 11%. Okay. And so can you please help me with the attrition rate for Q4 and FY22, and what are we, I mean, if it's high, what are we taking, what measures are we taking to curb that?
Sorry, attrition was the question?
Yeah, that's right, sir. Attrition. What is the attrition rate for full year FY22?
So we've given a lot of details in the investor pack. We track it separately between onshore and offshore, right? Slightly different markets in how they behave and different talent markets. What we saw in our onshore markets, UK and US, attrition was high and then peaked in Q2, but it has started to come down from a peak of 60+%. It's now kind of close to mid 40s in Q4 for our US and UK markets. Offshore has picked up slightly. It's about 50% now. And it is 50% because, for the last several quarters, given the COVID and work from home and sort of psychological safety, it was artificially low. It is starting to come up now. But net for the year, we have ended at about 50% onshore and 46% offshore. As we go into next year, I think we have a number of new actions in place. We did wage corrections for the frontline staff, given high labor market in both US and UK. And, our investments in leadership development, engagement, and making the work from home model work, I think they should have a positive impact on attrition. Clearly, I think most of us in the industry are shifting away from, hey, work from home is transitory, to now what is the long-term model? And still, a big chunk, a majority of the folks are still working from home. So I think this new reality and settling into that, even when COVID's impact is gone, is something which needs to play out. And we're working hard, like everybody else, to find new equilibrium. But my sense is we should have better attrition next year, despite still very red hot markets both in US and UK.
Okay. This was very helpful. Just last one, if I can squeeze in. So just wanted to ask, I mean, if you have any acquisition plans for FY23 or FY24, and if you can quantify that, and if you can highlight the debt value in INR terms, if you can help me with that.
Sure. So look, acquisitions, I've said that we have a systematic strategy of finding growth adjacencies in our core areas that we operate. In the last 18 months, we've done 3 acquisitions, all adding something to our existing businesses in provider, collections, and mortgage. We continue to take that strategy forward. And I think nothing specific to report, but this strategy of tuck-in acquisitions, paying largely out of cash flow, that I think will continue through FY23 and 24. We do think we have built an engine and the leadership team to be able to take on additional areas where we think there are opportunities. And we built up our network of channels to kind of get good visibility on deals happening through around the markets that we operate in. So nothing specific to report, continuation of the same strategy, and you should continue to see small tuck-in opportunities come through.
Okay, that's it all from my side. Thank you so much and good luck.
Thank you, Sanjay.
Thank you. The next question is from the line of Nagaraj Chandrasekhar from Laburnum. Please go ahead.
Hi, Vipul and team. Congrats on a good quarter under circumstances in the mortgage market. Just want to understand, given what really is the impact of high inflation on our company? On one hand, you mentioned greater demand for our services. On the other hand, we see higher attrition and a need to pay up for staff, while most of our contracts are longer tenure fixed rate contracts where we get a volume benefit, and volumes don't necessarily go up if there's inflation, right? So how do those two really work out in past periods of high inflation and talent and shortages? What have we seen on the margin front in the past?
Yeah. No, great question. Look, inflation is real, and if you look at the frontline staff and those wages, the components of that basket of consumption are obviously particularly hit, right? Food, fuel, energy prices, etc. So we have been very focused, proactive in making sure that we are, increasing our hiring wage, and we are adjusting it for existing employees. I think that has had, these are stuff that we've done mostly in this quarter. I think that has a positive impact. And it kind of sets the base now for the future hiring that, hey, this is the increased salary that we'll hire at in the future. Now, obviously, a lot of our contracts have index-linked provisions, either linked to minimum wage or living wage in the UK. So those are automatic. But given the more broader inflation, for most of our key clients, we've initiated dialogue. We've gotten good direction, even approval from a couple of large clients for, higher than normal rate hikes. Not necessarily all from today, but sort of from laying out from the future. And other clients have shown openness that when the contracts come up for their anniversary cycle, at that time they will consider sort of gain. So it's kind of bespoke arrangement. We're talking to big clients on there. The other way to think about is that talent shortage is real for everyone, right? Even for in-house operations for our clients. If you think of provider business has severe talent situation. Healthcare broadly is facing the same challenge. For health plans are facing the same challenge in US. What is good is that it is creating demand for offshore and openness for offshore. So Mexico has gone live, and now we have active conversations from other clients to say, yep, Mexico is a viable option. Philippines demand is becoming more real. And then obviously there is India, and then the move to chat to say, how much can I devote to chat? And I'm more comfortable taking chat offshore than I was taking, calls offshore. So nearshore and offshore and channel migration are the most structural options to take care for that. This year, net, as I pointed out, from a margin standpoint, it will have some downward pressure. That's why we've guided to somewhat lower margin for this year. And, as recoveries and price hikes play out, we should see margin come back to 11.5 to 12% by the end of the year. Dinesh, anything else to add on the inflation and client recovery?
No, I think very well covered.
I understood. Just the post FY23, what do you see the longer term growth trajectory possible within the healthcare business, both on the plans and provider business? What do you the most visible sign of a turnaround is what we've achieved in the payer business over the last 2 years. But how much further is there to go? Could we see both these businesses to 15% growth over a 4-5 year period? Given the large amount of talent we want to work with many employers.
Nagaraj, your voice is a little breaking, but I think I got a sense. The question you're asking is, what is the longer term growth trajectory of the healthcare business?
Yes.
Yeah. Okay. So take two parts. Obviously, we have been rebuilding our HPHS, health plan and health services business, last 2 years. I think it's done fantastically well, both quantitatively and qualitatively. In terms of the size, has doubled from what it was on a run rate basis, as I said, Q4 20 to Q4 22. We put in 3 or 4 strategies for growth in that area. 2 of them are traditional established areas, traditional BPO, claims processing, etc. But 2 more technology-driven BPaaS, bespoke BPaaS for mid-market, as well as digital intake for pretty much everyone. Those are still, I think, in the early days, and we see a lot of growth trajectory for digital intake as well as for BPaaS. And I think given the size of that market, I'm confident that we can continue our growth trajectory in HPHS that we've seen in the last 2 years. At least for the next few years, we can see that continuing, right? And keep in mind, this has been all organic. The provider business, where we play in narrower segments of the market, we are leaders, but narrower segments, that has been muted last 2 years. As I said, this quarter was one of the best from a sales standpoint, the best we've seen in the last 2 years. What we are also doing is we are expanding the scope of what we play. And again, offshoring comes into play. We are developing new offerings which kind of clients are more amenable from an offshore standpoint, given the talent situation. So from a normal growth recovery as well as increasing the scope of where we play, I am cautiously optimistic that providers will have healthy growth this year, and as we get into next year, it should start to build on that momentum. So the net FY23 and 24, we should definitely see at least company average or maybe slightly higher than company average growth in the overall healthcare segment.
Got it. Thank you.
Thank you. The next question is from the line of Shraddha from Asian Market Securities. Please go ahead. Shraddha, your line is in talk mode.
Yeah, hi. Thanks, Vipul, and congratulations. You did indicate that you expect mortgage revenue decline in 1 year. I believe the current...
Ma'am, sorry to interrupt, but your voice is breaking up in between. Maybe we request you to move to a better reception area, please.
Yeah, is it better now?
Yes, ma'am. Please proceed.
Yeah, hi. So I was saying, you did indicate that you expect decline in mortgage revenue in 1Q. So from the current run rate of close to $47 million that we're doing in mortgage, what is the kind of decline that we should build into our model for 1Q?
So, Shraddha, as you said, we gave a lot of detail. At a full year basis, right now we have modeled mortgage at between 125 to 135-ish million for the full year. Of that, we expect about 2/3 will come from servicing and the remaining will come from origination. Right, and which is a very different composition from what we have had in the past, right? It's kind of almost inverse of what we had in the past. So our run rate for Q4 in mortgage was about sort of 44 to 45 million. I think it was 45 million. But as we get into the next 2 quarters, we expect that will be more in the range of 30 to 33 odd million dollars.
Okay. 30 to 35.
30 to 33.
Okay. And another thing is you did indicate about the growth trajectory of the company in the healthcare segment in particular. But beyond FY23, how should we look at Firstsource as a composite company in terms of growth rate? Earlier, you used to have this aspiration of being in the top quartile growth rate vis-a-vis peers in the BPM industry. So how should we look at medium-term aspiration for us now going beyond FY23?
Sure. So, Shraddha, even for FY22, we've gotten to 14.7. Next year, we're saying 7 to 10. But if you exclude out for the transition of revenue from mortgage, as I said, it will be about 18 to 22%, which reflects a more diversified business even from FY22. So if you take that forward and take it to FY24 and 25, I am very confident of returning back to that aspiration, even at the net growth level, right? Baking out all the uncertainty. And sort of at this stage, very confident that we come back to that top quartile, low double digits, sort of mid-teens kind of growth at a company level. We've talked about our established businesses. We are also obviously incubating newer businesses that I've hinted in the past. Those are something, it'll take a while, but I think we are building those growth waves for the future as well to supplement the existing businesses of BFS, CMT and healthcare as well. So yeah, back to the core question, we FY24 and 5, I'm confident that we'll come back to that aspiration.
Right, that helps. And just one number-related question: what should be built in for capex number for 23, and what is the pending payouts on the acquisitions and the mortgage client payouts for 23?
Yeah. So your question was capex and the pending payout for acquisitions and the mortgage minority buyout, yeah?
Yeah.
Dinesh, do you want to take that? Or Ankur?
Yeah. We built in around $8 to $9 million because I think as of today plan is more of a technology side capex which is going to take place. So that has been built in there. And on an acquisition side, Ankur, do you have the number ready?
Yeah. So Shraddha, on the acquisitions, the numbers are contingent on performance with the earn-outs. Assuming if the targets or the businesses perform to full potential, the payout could be in the range of about $12 million. And regarding the mortgage deal that we had signed, again, contingent on certain outcomes. And that would also, I think, be, in the range of around $5 to $10 million, depending upon where the land's at.
So this $2 million is combined on both the acquisitions?
$12 million, 1, 2, yeah.
Sorry, 12. Okay, and mortgage is $5 to $10 million.
Correct.
Yeah, that's helpful. Thank you and all the best.
Thank you. As there are no further questions, I now hand the conference over to the management for closing comments.
Thank you. Again, thank you everyone for joining late in the day. It's been interesting 2 quarters. I'm looking forward to more steadier and uneventful 23 and come back and talk to you about the progress we make. Thank you again for joining and your interest in us.
Thank you.
Thank you, everyone. Thank you.
Ladies and gentlemen, on behalf of Firstsource Solutions Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.